Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets, and analyse the issues impacting the Kiwi economy. Let's get into it. Kia ora and welcome back to Markets, Mystics and Mayhem. We're on episode 8 and it's going to be a really interesting episode. We're going to talk a little bit about monetary policy and what's happened so far, where we think it's going to go. We've heard from Governor of the Reserve Bank, Adrian Orr, and we're going to kind of dig into what he's said recently. And then we're going to do a little bit of comparison of the Trans-Tasman economies, see how each economy is kind of holding up, how that economic scorecard is holding up. But that is the episode this week.
Yeah, and like you say, quite an interesting one and lots to talk about. Adrian Orr did give a speech, and there was a few little snippets in there that have got some attention in financial markets. He mentioned the word incremental. What on earth does that mean? But he was also quite happy, right? He was quite happy with the way inflation has fallen. So, what did you get from the speech, MJ?
Yeah, it was a really interesting speech. He kind of had reflections on how monetary policy, how challenging it's been to, do monetary policy over the last few years. It's been very turbulent and a very volatile period. So he had kind of looked back and how monetary policy had fared. But now he said that we're much calmer waters. That's a direct quote. And in these calmer waters where inflation is kind of back within the band, they can be a bit more, circumspect, is what he said about the way down. So they were very aggressive on the way up, hiking 50 basis points a couple of times. I think he even did a 75 in November 2022. But now that inflation is, reined in back within the band, they can be a bit more incremental in on the way down.
Yeah, so I guess at face value, it almost, takes away the chance of a 75 basis point cut in November. But it certainly doesn't take away from more 50s, I don't think. So, like you said, they were very aggressive in hiking. It was the most aggressive hiking cycle I think we've seen since the Reserve Bank started targeting inflation. Lots of 50s, and then, as you say, a 75. And on the way down, they've done a 25, a 50. We think they'll do another 50 in November, another 50 in February. But at that point, you get the cash rate down, to 4% and below. And I think once they go below 4%, that's when they become a bit more incremental and doing 25s, because they've gone up from just 0.25% all the way to 5.5%. They're not going all the way back down. We think they're going to go back to sort of 2.5, 3, somewhere around there. So next year will be, I think, a lot more 25 basis point moves. But to kickstart, we've seen a 50, and we'll probably see a couple more.
Yeah, because I guess the key thing to note is that cash rate at 4.75, where it is today, that's still very restrictive. It's still well above what we've estimated to be neutral at 2.75, and it's actually still at levels where inflation was well outside of the Reserve Bank's 1 to 3% target band. We're now at 2.2% inflation, so there's no need to have the cash rate so restrictive. So I think those 50 basis point moves, which are, I guess, by historical standards and by traditional standards, is quite large, but that's needed to get us, closer to more neutral levels.
Yeah, 2.2% inflation should be celebrated. We got there a little faster than even we were expecting, and we were on the dovish side of consensus. So it does need to be celebrated. I think the fact that businesses aren't passing on as much in the way of price gains is interesting as well. But I think, the Reserve Bank would be very happy with the fact that inflation expectations have come crashing back down to 2% flat. So in their last survey, where do you expect inflation to be in 1 year, 2 year, 5 year, 10 was pretty much flat at 2. And from their point of view, that's great because inflation can do whatever it's doing. But if everyone expects it to go back to 2, well, that's their credibility check that they're going to do their job. And it's also, in the back of all our minds when we're setting prices. So, if we're all expecting 2, then it becomes self-fulfilling. So, yeah, I think they should celebrate the fact that they have got inflation back to just 2.2, long way from 7.3 peak. I think that war has been won. And as you say, it's about, cutting to a more neutral Goldilocks type level. One question I've been getting quite a bit on the road is, how fast will these rate cuts feed through? We've been asked to think about Christmas. What is spending likely to be at this Christmas compared to last, and how quickly are things going to feed through next year? What are your thoughts on that, Andrew?
Yeah, I guess, well, traditionally monetary policy operates with about a 12 to 18 month lag. But this time around, I think that transmission of monetary policy and those rate cuts could actually come through much quicker. Because if you're looking at the mortgage book, lots of, borrowers are kind of fixed for those shorter terms. That's, I think, 75%, isn't it? That's fixed for less than a year. And that's quite a punt because the shorter end rates are actually more, are above the sort of 2-year rate. So they're taking a punt on it where interest rates will be in 6 months' time, in a year's time. And I think for the most part, they've been correct because the cash rate has been falling.
Yeah, exactly. Normally, customers just look for the best price. So, you'll have a mortgage rate curve. The 1-year rate might be higher than the 2-year rate, and the 3-year rate might be higher than the 2-year rate as well. So people will just go for the lowest point on the mortgage rate curve and say, I'll just take the cheapest. I'll just take the lowest one. Whereas this time, the 6-month rate is significantly above the 1-year and the 2-year and 3-year. But they're ignoring that, and they are taking a punt, and that punt is paid off. It'll be interesting to see how fixing evolves next year as we sort of find that bottom. I think people will go out again, but yeah, the good news is that 75% of the mortgage book is fixed for less than a year, with a lot of people punting on that 6-month rate. So they're going to get these rate cuts coming through faster than normal. So not so much the 12 to 18 month historically, maybe more the 6 to 12 months. So that's good news for households and businesses, but also the Reserve Bank. It's quite a frustration at the Reserve Bank where you're setting policy today knowing that it's going to take 12, 18 months to feed through. And especially when you're cutting, you kind of want that stimulus or that relief to go through quite quickly. I remember in 2008, they were slashing, 100, 150 basis points at a go, but, it took 18 months to 2 years to sort of feed through. So very frustrating in good times and bad.
And I think this because of that, we are more confident. We've said in previous episodes that 2025 will be the year that we climb out of this recession that we've had for the last 2 years. So I think this turnaround in growth and activity would come much faster than otherwise, than if that were the case.
Yeah. And, what's going to happen to spending over Christmas? I'd like to think that it's going to be better than last year. And I'd say that with some confidence now that we've already seen sort of 75 basis points of cuts, and we may have seen 120 basis points by the end of November. So even if that hasn't fed through to your mortgage rate, that it's going to, and I think you'll feel a little bit more confident, a little bit better about your household finances. And we do know that there are a lot of people rolling off. So before Christmas, so I think we will see a bit more spending over the holiday period, which will be great. Hopefully we get a bit more tourism as well, which would also be great. Weakness in the Kiwi dollar helps there. But then, if we're looking at our forecast next year, MJ, I mean, what have you got? What have you got sort of plugged in?
Well, next year, I think we'll see, growth returning to sort of 1 to 2% next year, which is much better than what we've had now. I think right now we're at minus 0.1, which is practically flat and contracting. So it's been a really, really weak economic period. But yeah, next year we should see that growth momentum start to build. And then 2026, I think we've got penciled in the return to more longer term average growth of about 3%. So that's pretty good from what we've had the last few years.
Yeah, so it's a recovery, but it's still a slow recovery, and one that will kind of grow and grow and grow, but take time nonetheless. So with that, I think it's interesting to compare ourselves to Australia, and it's also fun to compare ourselves to Australia. New Zealand's gorgeous country, a lot of really cool things happening here, but we generally have to really look after our land and try and grow things. Whereas in Australia, things are a lot simpler. For those who are a fan of the movie The Castle, you should go and watch it if you haven't. They just dig holes. So if you want to talk about the history of Australia, we dug a hole and we dug another one, and we'll keep digging holes. It doesn't matter where you are in Australia, you dig a hole, you dig deep enough, there's something shiny at the bottom of it. Could be gold, silver, oh God, coal, what else have they got there? Pink diamonds, uranium. It is the lucky country because, it's not that hard. You dig a hole. But what's interesting in the COVID period is we reacted very similar as the pandemic unfolded. Monetary policy was slashed hard and fast. We cut to just 0.25%. They cut to just 1/10, just 0.1. But the removal of that stimulus was quite different. The Reserve Bank of New Zealand was much more aggressive than the RBA. What did they do, MJ?
Yeah, the RBA, I guess the best way to put it is that they were very late to the party. Lots of central banks had already started hiking rates. I think the Reserve Bank of New Zealand was among the first, and then the RBA was among the last into the hiking cycle. So, and not only were they last, they also didn't hike as much. So I think I saw somewhere where they only hiked the cash rate 83 basis points above neutral, whereas the Reserve Bank of New Zealand hiked by over 200 basis points above neutral, 275 basis points. So there's that very big difference in monetary policy strategy post-COVID, and that's why we're seeing such different economies right now between Australia and New Zealand.
Yeah, so it seems, it is the case that, the RBA was much more willing to risk higher inflation for longer to sort of insulate or protect the economy from going into quite a bad recession, whereas New Zealand we hiked aggressively and the Reserve Bank engineered a recession that lasted 2 years. So there's a really big difference between the Reserve Bank of New Zealand, who went really hard, almost scorched earth type policy, whereas the RBA was, we're happy to let things run. And at the end of the day, who's got the higher unemployment rate? Who's got the weaker economy? New Zealand, right?
Yeah, exactly. I guess for both those reserve banks, it was kind of job done for both of them, because the RBA, yes, they've got much more elevated inflation. It's coming down, but more, a slower pace, but their labor market is still very strong. Unemployment is there at 4.1%. They're still recording pretty strong employment growth there. On the other side, here in New Zealand, we've had inflation, as we say, back at 2.2%, so a much faster drop. But unemployment is obviously very clearly rising here. So it's kind of with their intentions, you can sort of debate the merits of the strategies, but both have kind of achieved what they wanted to do.
Yeah, and I think looking back, I think many people will say, well, maybe the RBA, who were a little less aggressive, got the better outcome in the end. And unfortunately, where does it show up? Shows up in our migration. I mean, you do a lot of work in the space. It's hard to forecast migrants coming in, but Kiwis leaving, we do tend to look at the relativities between us and Australia and the UK, and what are you seeing there? It's pretty obvious, isn't it?
Yeah, we've got a record outflow of New Zealanders leaving, and most of them are leaving to Australia. And again, yeah, you're right, it's about the relative performance of the labour market. The Australian labour market is very strong. Unemployment rate there at 4.1%. It's below trend there, whereas we're climbing to past 5% here. So you're seeing the sort of outflow of New Zealanders going across to Australia. And again, that's just a function of monetary policy, because they were because the RBA wasn't as aggressive. Their labour market is still relatively insulated, so they're continuing to grow. Whereas we've been more aggressive. We've had a much deeper slide in economic activity, so we're seeing these unemployment losses kind of climb and grow. So we're seeing that continue. So that might continue into next year. That outflow might just continue expanding given a weaker labour market here. But again, things should turn around given that we're stimulating faster in the sort of second half of next year.
Yeah, we hope so. But I'm certainly hearing that on the ground as well. I was in Wellington recently, and I've been a number of the regions, and Wellington has been hit quite hard with some public sector job cuts, and I'm hearing that some of those people are taking flight and looking at Australia. Like you say, it's if there's jobs in Australia, you're willing to cross the ditch to get one, right? Particularly if you're out of work and there's nothing else around. And I'm also hearing that some of these migrants who have come to New Zealand looking for jobs can't find the jobs, or those jobs that they were promised have evaporated, and they too are bouncing across to Australia. So that outflow is very strong and probably going to be strong for some time.
That migration boom, it almost feels like it's come a little bit too late, because we needed those people for sure during COVID, when demand was very strong and labour shortages are very very obvious. But now that they've come, we opened the border, and now they've come, but the economy is in a much weaker state, and demand has been crushed. So yeah, it almost feels like this migration wave had come maybe like a year too late.
Yeah, it is a shame, right? There was quite a period there from sort of 2022, 23 that we were screaming out for workers, and now it's the other way around. It's interesting, the migrants that we have coming in here, tick the right boxes. We are getting the tradies, we are getting the construction workers, we are getting nurses, we are getting teachers, we are getting a lot of the right workers in the right place, but it didn't come at the right time. So they're not getting those jobs, unfortunately.
Yeah, I think I remember looking at it, and it was cooks and bakers. They were sort of top of the list, which is not usually the case.
No. But hey, that's got to be part of the tourism story as well, right?
Yeah, I think that's the big thing that we're looking out for over the summer period. Whether we see our tourism bounce back, it's still not back to pre-COVID levels. That's the one aspect of our economy that's still kind of struggling. So this upcoming season, international tourism season, should be interesting to see if they do bounce back.
Yeah, and if it does, if we do get the Chinese tourists back as well, we could be sitting pretty in just a few months. So if we're right and consumption starts to pick up with these rate cuts, and we get a bit more on the tourism side, we could be recording some decent gains earlier than expected.
Yeah. It's going to be nice to see some upside surprises and growth for not been that case for a long time.
2 years, yeah, exactly. Looking forward to it, and we're definitely optimistic heading into next year, given these rate cuts, and hopefully we start to see a housing market that recovers and picks up, because that'll be key for consumer confidence, right? Their finances improving, and also their balance sheet growing again as house prices pick up. That'll be a big driver of growth, I think, next year, and for small businesses as well, particularly those that have a house linked to their lending. So the comparison between Australia and New Zealand, it does play out in the currency, the Kiwi-Aussie cross, which is a very volatile cross, just quietly, and can bounce around all over the place. But if we're thinking that the Reserve Bank of New Zealand is going to be doing a lot more cuts than the RBA, then that interest rate differential, so our interest rates relative to Australia, but we did say that the Reserve Bank of New Zealand hiked a lot more, but they're cutting as well. So I think we're going to see the New Zealand cash rate cut below the Australian cash rate for a while, and that differential in short-term interest rates, is a big driver of the currency, and we are starting to see, or we have seen, the Aussie dollar strengthen versus the Kiwi. That's good, right? That is good for our exports. What is Australia, our second largest trading partner? So, New Zealand goes on sale when the currency drops. Everything in New Zealand looks cheaper to an Australian, and they might travel here, or they might buy more of our stuff. What do you reckon, MJ?
Yeah, yes, all the fundamentals are pointing to a lower Kiwi-Aussie cross. But it's interesting. We've been saying it for a while, but it's kind of been trading quite range bound. But you call the Kiwi-Aussie cross the Widowmaker for a reason. What is that reason, JK?
It's called the Widowmaker because so many people get carted out trying to trade the Kiwi-Aussie cross. It can be very, very tough. You can come up with a great fundamental reason as to why the Kiwi is going to depreciate against the Aussie, just as we've outlined, RBNZ cutting more and below the RBA's cash rate, but doesn't necessarily mean it gets there immediately. It should get there based on the fundamentals, but in the meantime, it can do anything really.
Yeah, so we're holding on for that sort of 80, 89.
White knuckle ride.
Yeah, we're holding on to that, and maybe we get there all in one go if it's that volatile.
Exactly. It could get there real quick.
But that's it for this episode. It's been really interesting, kind of looking at the economic scorecard between Australia and New Zealand. It's an age-old rivalry, and on the economic cards, it doesn't look like we're holding up too well, but these fortunes may change given that the Reserve Bank is cutting much faster than the RBA, who may not cut till maybe next year. So it's something to keep an eye on as always. But thanks for listening. Please follow the podcast. Please share the podcast, and we'll be back the next week.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.